Yardeni Research President Ed Yardeni joins us this morning. Ed, it's great to have you.
Thank you.
It's been great to read your stuff lately. You've been talking about your 5,400 year-end, your 6K year-end 25. If anything, your concern was about a potential melt-up in some irrational exuberance. Did either the print or the action yesterday change that?
I hope so. I would not like to see a melt-up. I mean, they're a lot of fun on the way up, but almost by definition, melt-ups imply that they'll be followed by meltdowns. So, yeah, I'd like to see this just continue to be a normal, civilized bull market, move up along with earnings and economic surprises on the upside.
Did you see anything that suggested that the data yesterday will interrupt an overall downward trend of inflation?
Not the way I sliced and diced it. I think the Fed could look at it and conclude that maybe they were smart not to move too quickly here and confirming that the market's right. I think the market's wrong. I think inflation is coming down, but that's no reason for the Fed to rush to lower interest rates when the economy is doing so well. I mean, why mess with success is my motto here in thinking about the economy. But when I look at the CPI numbers yesterday, they weren't bad. You know, I'm a big believer, Carl, of taking out whatever doesn't support my story. And so if you take out shelter, the CPI inflation rate, both core and headline, were right around 2%. The CPI is already at 2%. It's just that annoying shelter component that's taking a sweet time coming down.
Right. And it's that gap between OER and primary rent or OER and new rent. Yeah. Is it ticking longer than it should?
Not really. I mean, it's doing what it typically does. So it's nothing new. And I think the Fed would be wise, and all of us would be wise to take a look at what inflation is doing, excluding shelter, recognizing that market indicators of rent have come down rather substantially. So I think we've made a tremendous amount of progress in bringing inflation down. But again, I don't think the Fed has just tightened over the past 2 years. I think they've also normalized. Everybody who keeps pointing out that the Fed has raised interest rates by 525 basis points should really mention that from where? From zero. Zero was abnormal. Rates are back to normal. 4% is where the bond yield should be, in my humble opinion, given what the economy is doing with low inflation.
I mean, there were also some pop-ups of inflation in medical insurance and transportation services.
Sure.
And I mean, I get it that shelter was the big thing there. Food ticked up. The Fed does not want to see those go in the higher direction at this point of the tightening cycle. I guess the fear is if they continue to get evidence that they need to see more evidence to cut rates, if they push it out and push it out and push it out, does that start to have a more restrictive and more harmful impact on the economy and the market?
Yeah, I don't necessarily think so. And by the way, I think we can get kind of lost in the details when it comes to the CPI report. I mean, certainly you could pick out that auto insurance increased, I think, 20% year over year. It was just a high flyer. But I think that this year would recognize that shelter is a bit of a bizarre component that takes a while to come down. But I don't view that the current level of interest rates is going to kind of create a lagged effect, a long and variable lagged depressing effect on the economy. You know, what really in the past has caused recessions has been monetary policy causing a financial crisis, something to break, causing a credit crunch, which is then what causes recessions. This time around, the Fed did, in fact, create a little crisis there in March of last year. But within 2 days, they came up with a liquidity facility. And so we haven't had a credit crunch and we haven't had a recession. I think the economy's doing fine.
I see it right here.